Our last discussion looked at Joby Aviation Inc. and that, fascinating landscape of the eVTOL market. Today, we're shifting our focus to a company that presents an incredibly intricate financial picture. Hyperscale Data Inc., trading as GPUS. This is a highly diversified holding company with operations that stretch across data centers, Bitcoin mining, defense, real estate, and financial services. Quite a mix. The core attention we'll be dissecting with GPUS. It sort of revolves around its dual nature. On one hand, we see a history of pretty severe underperformance. On the other hand, there's this bold, aggressive strategic pivot into high-growth, capital-intensive sectors like AI data centers and cryptocurrency. So the central question for our debate today is this: stressed company attempting to mask fundamental issues through highly speculative ventures. I'll be making the case for the company's strategic repositioning and its potential for future growth.
And I will be scrutinizing the, frankly, significant financial challenges that Hyperscale Data faces, alongside what I view as the highly speculative nature of its current ventures. My perspective suggests that when we really dig into the fundamentals, a more concerning narrative emerges, one that really calls into question the sustainability of these ambitious plans.
Okay, let's start with the elephant in the room. Hyperscale Data's historical stock performance has been, undeniably tough. On September 5th, 2025, the stock closed at 0.4391. The performance metrics show significant declines with a staggering negative 90.97% year to date and, a full negative 100% loss over 3, 5, and 10-year periods. Now, for many, that would be a huge red flag.
Huge.
Right. However, I see this historical context as a critical pivot point for a company that is currently undergoing a profound strategic transformation. My focus is on their very strong commitment to AI data centers, particularly their Michigan project. They're targeting a full build-out of 340 megawatts by 2029, including crucial installations of NVIDIA GPUs. This isn't just a minor adjustment. It's a decisive move into an incredibly high-demand, high-growth area that is, central to the future of technology. Beyond AI, Hyperscale Data has also made a significant push into the cryptocurrency space. We've seen substantial Bitcoin mining revenue, hitting approximately $1.8 million in July 2025 alone.
Just in July?
Just in July, yeah. Pushing their year-to-date total to $11.2 million. And importantly, their Bitcoin holdings have reached 8.1% of their market capitalization. These aren't just tangential activities. They represent substantial investments and a growing revenue stream within a high-potential asset class. Furthermore, we're starting to see real operational improvements. Preliminary Q2 2025 revenue came in at $25.8 million, which is a robust 45% increase year over year. The company has also reaffirmed its full year 2025 revenue guidance of $125 million to $135 million. Critically, they've been actively strengthening their capital structure through debt reduction, citing recent paydowns of $25 million and $20 million. And finally, the executive chairman, Milton C. Alt III, has visibly demonstrated his confidence by making multiple purchases of GPUS stock in August 2025. Often a strong signal of internal conviction in the company's long-term vision.
Okay, I appreciate that perspective, but I think it overlooks a critical point. While the narrative of strategic transformation certainly has an appeal, it stands in stark contrast with Hyperscale Data's severe current financial metrics. I mean, we're looking at a company with a market capitalization of a mere $11.92 million, yet its enterprise value, which includes its debt, is a much larger $80.44 million. That immediately tells me there's a significant debt burden relative to the company's equity value, which is, it's a huge red flag. My concern really deepens when we look at their consistent, deep unprofitability. A trailing 12 months earnings per share, that's how much profit they generate per share over the last year, stands at a deeply negative 31.77. And the net income, the company's total profit, is a staggering $56.14 million. But beyond just raw losses, let's consider their operational efficiency, or perhaps the lack thereof. Their profitability ratios are simply abysmal. return on assets at negative 21.25%. Return on equity, which tells us how effectively a company uses shareholder capital to generate profits, is at an alarming negative 319.34%. Their return on invested capital is negative 576.15%, and their overall profit margin is negative 55.38%. These aren't just bad numbers. They expose fundamental operational challenges, indicating the company is actively destroying shareholder value. It raises serious questions about whether any new venture, no matter how promising, can truly overcome such deep-seated inefficiency without a radical overhaul far beyond just strategic pivots. And this brings me to their liquidity and debt position. A debt-to-equity ratio of 20.71 is exceptionally high, meaning they're overwhelmingly financed by debt rather than shareholder capital. And with quick and current ratios hovering around 0.30, their short-term assets are barely a third of their short-term liabilities. That signals severe immediate liquidity constraints. How can a company with such limited short-term cash and assets realistically fund these capital-intensive pivots you're describing? Furthermore, the sheer breadth of their diversification across defense, real estate, commercial lending, crypto, and AI, it just raises questions about focus. Are they spreading their limited resources too thin rather than achieving critical mass or genuine expertise in any one area? And let's not forget the notice of non-compliance with NYSE American listing standards back in December 2024. That points to a history of past regulatory and financial instability that's still very much a part of this company's recent past.
Okay, I see why you're highlighting those financial metrics, and they certainly present a challenging picture. No doubt. However, my perspective focuses on the strategic intent behind these shifts and their forward-looking potential. While the historical numbers are indeed a significant hurdle, the strategic pivot into high-growth sectors like AI and crypto, coupled with the emerging from Chapter 11 for its Gresham Worldwide subsidiary, that indicates a crucial restructuring and a clear forward-looking vision. To clarify, emerging from Chapter 11 means Gresham successfully completed a court-supervised restructuring of that specific business, effectively shedding legacy debt and liabilities. It allows it to operate as a leaner, growth-focused entity once again. This isn't just a minor event. It's a concerted effort to shed legacy issues and focus squarely on growth segments.
And the positive preliminary Q2 revenue growth of 45% year over year isn't just a minor uptick. It's an early and tangible indicator that this new strategy is gaining traction in the market. It suggests that these new revenue streams are not only developing, but are also growing pretty rapidly.
Right. That's a compelling argument about the strategic direction. Sure, but have you considered that fundamental structural issues may not be so easily overcome by new ventures? Especially when we look at the depth of the financial hole we just discussed. The extreme negative profitability metrics and historical stock performance point to deep-seated problems that new strategic directions haven't yet, or maybe just aren't able to, resolve. Despite generating over $100 million in sales, the company's price-to-sales ratio, which indicates how the market values its revenue, is a mere 0.12.
Right, very low.
Low. This suggests the market is highly skeptical of the quality and sustainability of its current revenue streams and its overall growth story. It simply isn't valuing those sales very highly. And how do you reconcile that with the constant need for financing? We've seen an at-the-market offering of common stock announced in August 2025. This mechanism, it allows a company to sell new shares directly into the market over time, and it signals an ongoing cash burn that these new ventures have not yet alleviated. It points to a continuous reliance on external capital simply to keep operations afloat and fund these ambitious projects. Isn't that a sign that the underlying financial stability is still severely lacking?
Well, my view here stems from the fact that we're talking about investments in AI data centers, specifically equipped with NVIDIA GPUs. They are tapping directly into a rapidly expanding foundational market. This isn't speculative in terms of market need. It's a strategic move into essential infrastructure. The substantial Bitcoin mining revenue, $1.8 million in July, $11.2 million year to date, demonstrates a strong commitment to a high potential asset class. And while it has inherent volatility, the consistent generation of revenue from it is a clear positive. Furthermore, beyond just mining, subsidiary innovations like StableShare for tokenized securities, and Only Bulls, a mobile investing app with an AI market agent. These illustrate an adaptive and forward-thinking business model. It's about leveraging technology in diverse financial applications. And while the trailing 12-month losses are significant, yes, the positive EPS over the past 3 and 5 years, along with a strong EPS quarter-over-quarter growth of 92.96%, that suggests underlying growth potential when looking beyond the accumulated historical losses. These are tangible signs of a potential turnaround, not just speculative hopes.
I come at it from a slightly different perspective. While the AI market is indeed expanding, and I do acknowledge the revenue from Bitcoin mining, the inclusion of meme coins like Pepe and Trump in their subsidiary social casinos is, frankly, a questionable revenue strategy for a company trying to pivot into hyperscale data. It kind of blurs the lines between serious data infrastructure and highly speculative, almost entertainment-driven ventures. It makes me wonder, is this a genuine pursuit of cutting-edge data infrastructure, or is it a risky foray into highly speculative areas that dilute their core focus and brand identity, especially when capital is so desperately needed for their announced AI build-out? Okay, I see the point on the branding. Furthermore, the inherent volatility and speculative nature of cryptocurrency are undeniable, especially for a company with a beta of 4.57. For our listeners, a beta of 4.57 means its stock price is significantly more volatile, over 4 times more than the broader market, amplifying risk considerably. Can a company with an $11.92 million market cap and severe unprofitability truly execute capital-intensive projects like building out a 340-megawatt AI data center campus by 2029? This requires immense, sustained capital, and their current financial state really calls that capability into serious doubt. It reminds me of trying to build a skyscraper on, shifting sand. No matter how ambitious the blueprint for the top, the base dictates the ultimate stability.
I appreciate that point about the scale of ambition versus current resources, though I would frame the insider activity and long-term vision a bit differently. The consistent insider buying by Executive Chairman Milton C. Alt III, even after a substantial drop in share price, signals strong internal belief in the company's long-term strategy and turnaround potential. This isn't a one-off purchase. It's a pattern that suggests a deep understanding of the company's prospects from someone directly at the helm. And while you highlight the ongoing need for capital, these insider actions, coupled with the company's efforts to reduce debt by $25 million and $20 million, truly support a move towards a stronger financial footing. These debt reductions free up capital and reduce financial risk, which is critical for a company undergoing such a transformation.
Well, my skepticism here stems from the fact that, while insider buying can certainly be a positive signal, in this specific case, it represents a relatively small percentage of total ownership. Insiders hold just 1.72% of shares. The narrative of strategic pivots and strengthening the balance sheet is, I think, consistently undermined by continuous capital raises. We've seen that $100 million financing agreement in August 2025 and a $50 million equity financing back in April 2025. These constant infusions of capital inevitably lead to dilution for existing shareholders, constantly pushing down the value of their holdings. This underscores a persistent reliance on external funding to manage its operations and investments, rather than generating sufficient cash flow from its core operations to fund its growth ambitions. How can we truly believe in a strengthening financial footing when the company's constantly seeking more capital just to keep its ambitious projects in motion? It suggests they're constantly plugging holes rather than building a truly sustainable financial foundation.
Okay, so to summarize my perspective, despite a challenging past marked by significant underperformance, Hyperscale Data Inc. is actively and strategically repositioning itself in critical high-growth sectors like AI, data centers, and cryptocurrency. The positive preliminary Q2 revenue trends, the substantial investments in cutting-edge AI and crypto infrastructure, and the consistent insider confidence from its executive chairman all suggest a forward-looking strategy that, I believe, could unlock significant value for the company in the years to come. This isn't just a company treading water, it's deliberately charting a new course.
And I see it from a different angle. Hyperscale Data's severe historical financial performance characterized by a high debt load and deep unprofitability, combined with the highly diversified and inherently speculative nature of its current ventures, presents substantial and frankly undeniable risks. While the strategic pivots are certainly ambitious, their ultimate success remains highly uncertain, given the company's unstable financial position and its historical inability to generate sustainable profits. The challenges here appear to be fundamental rather than superficial, making the path to future success incredibly precarious in my view.
Evaluating a company like Hyperscale Data, one undergoing such rapid and multifaceted transformation, is undoubtedly complex. There are clear indicators pointing to a focused strategic shift towards high-growth areas, with tangible, albeit early-stage revenue growth.
And equally clear substantial financial hurdles and a history of underperformance that simply cannot be overlooked. Understanding GPU's future will certainly require continued close monitoring of its financial reports and, critically, the successful execution of its very ambitious operational plans. There's definitely much more to explore within this material as this story unfolds.